I funded hundreds of loans from Florida to Maine to California and everywhere in between. And in this video, I'm going to break down and rank by tier the best loan types for investment properties so that you can stop leaving money on the table. Starting with FHA House Hack. Now, this is a great place to start, but it's not a real place to actually grow your portfolio. The reason why is FHA loans are only meant for one property. You can't buy investment properties with FHA loans. The way it's called a house hack is because what they want you to do is take that FHA loan, go buy a multi-unit property. Think of a duplex, triplex, quad. You live in one of the units, you then move out, and then you can rent out the other units. It's a good way for you to get your first property, but it's not a good way to go ahead and grow your portfolio for the long term. D tier. HELOC on your primary residence. This one I have mixed feelings on. Obviously, a lot of people try to utilize this to take their next step because most people only own a primary residence and then they want to go ahead and make another move. And so then they'll take a second mortgage, a home equity line of credit on their property. The issue with this is that now you're putting an additional risk on your primary residence, and it becomes one of those things where now you have a second mortgage, your husband or wife might not like it. And the reality is the rate is going to be a higher interest rate than you probably like. So with that being said, I'm going to say this is F tier. Now, once you get some experience, maybe we could say this is a good tool, C, or even possibly a B tier for somebody who has experience and they need to pull cash to go rehab a property and they know that the HELOC will get paid off quickly. But for most people, F. Conventional loans, the tried and true, what everybody probably knows and what you've probably done on your primary residence, or maybe you have an investment property. The reality is that this is limited to 10 loans in total. So if you're really trying to grow a big portfolio, not for you. And the reality is most people don't even get to 10 because it has a max DTI of 50%. And a lot of people, when you start accumulating investment properties, or especially if you're an investor who's a self-employed person, the debt to income ratio becomes a problem very early on. Think 2, 3, 4 loans. When I worked at a direct lender, these people who were very qualified and have properties that were cash flowing couldn't get a loan with us and we were turning them down. How crazy. So this is definitely C tier. Hard money, or also known as fix and flip loans. I love these loans. They're definitely a good tool for people to really grow their portfolio. I have so many clients that utilize these loans to buy a property, fix it up, and either flip it to grow their war chest, or they come to me after and I refinance them into long-term financing. This is a rinse and repeat process that I've seen people go from having hardly any properties to 10, 15, 20 properties in a matter of years. So it's an awesome tool, but it doesn't come without its own trade-off, which is that they do come with high risk because they're higher interest rates, high cost, and short term. Typically they're 12 months. And basically, if you screw up the process of fixing up this property and not being able to flip it or not being able to refinance it in time, they can come in and foreclose on you or start charging you ridiculous fees. As somebody who's on the other side and helps investors get out of a lot of these hard money loans, I can't tell you how many disasters that I've seen with this because people either mess up their rehab and they get mid-rehab and they need more money. I've seen people not make the mortgage payments on these, and so we have a hard time getting them out of the loan. Don't just go with any hard money lender. Make sure you understand who they are and know what the actual terms of the loan are before you go ahead and move forward. Because of all this, I would say this is for an experienced investor, A tier. For inexperienced investors, D tier. Bank statement loans. Bank statement loans, if you're self-employed, this is for you. Instead of qualifying you based on your tax returns in a conventional loan, with a bank statement loan, you can qualify based on your business bank statements over the last 12 months. Now, unfortunately, this isn't for everybody. So I want to call it like A tier for somebody who is self-employed, and obviously an F tier if you're not self-employed. The reality is that the bank statement loans, what they do is they look at the last 12 months of your business bank statements, and they allow you to utilize those as your income versus your tax returns. They typically will take your total revenue over the last 12 months, and they'll give you typically 80 to 90% of the total revenue of that business, which is great because I've seen people go from literally not being able to qualify for a conventional loan at all to having like DTIs under 5%. It's crazy. So it just depends on the business you have, but it's definitely a highly effective loan for people who are self-employed, and I utilize it on a regular basis with my clients. Subject to, this is where somebody who's in a property and is having a hard time maybe making their mortgage payments, or possibly they're just trying to get out of a property, but they can't sell it on the open market the way that they want to. So an investor can come in and take over their mortgage payments for them and put themselves on title. So instead of the current owner being on title, you are now on title and you are currently making the mortgage payments on their behalf until you eventually refinance or sell the property. This is a great tool for investors because no longer do you have to worry about coming up with all this cash, say 20, 25%. to go in and buy an investment property. Also, you can negotiate with people and get better interest rates. I mean, right now we're in, 6-7% rates for most people. And instead, you can get some rates in the 2-3-4%. Now, of course, these come with some caveats, right? The property is probably behind on taxes or behind on monthly payments or behind on a lot of repair. As somebody who's on the other side of this fence and seen people who come to me who got into subject to properties, the properties were highly damaged and they had to do a bunch of rehab to the property to get it ready to rent out. And then what ended up happening is the property wasn't necessarily worth as much as they thought in the back end once they rehabbed the property. So it's not all glitz and glamour. You have to understand that there's a little bit more of a process to it, and still have to get into a good property and understand what the full mechanics of this property are going to be. And subject to is not a new thing. It's been around for a very long time. And somebody like Pace Morby has really pushed it into the forefront for people to utilize this as another option for people to grow their portfolios. With that being said, you really do need to educate yourself and understand the process. And I feel like that because of that, there's a lot of people who make mistakes and don't do it the right way. So because of this, I'm going to say this is a C tier. Good opportunity. Could it be an A tier and even S tier for some people? Obviously for Pace, yes, S tier all day. For some of my people I've spoken to and gotten to some bad deals and they're coming to me, begging me, James, Refi to answer me out of this deal. It's so bad. Those people, those could be D's or F's. So I'm going to put it right in the middle at C. DSCR. This is where you qualify based on the rental income of the property. Is the lease or the market rent enough to cover the payment, PITI, on the property? If so, the lender will do the loan. You literally just have to make sure that a property can cash flow with the new current payment that you're going to get on the loan, whether you're purchasing a property or refinancing a property. This opens up the doors to literally everybody, whether you are retired, whether you are working, whether you don't make a lot of money, you make a ton of money. It's all good. As long as we can show that it can cash flow, the lender will go ahead and do the loan. So if you haven't figured this out yet, this is for sure S tier. You can close in an LLC or you can close in your personal name. It's totally up to you. Some people get confused on DSCR loans because they hear what I just said in the beginning and they go, oh, we can just show that the rent covers the payment. We're good to go. This is true in terms of the income, but there's other things that you need to be able to prove and verify. One, your credit score. The credit score needs to be at least a 620. The higher the credit score, the better it is for you. So 620, you might be limited to say 65 or 70% LTV, but as you get higher, 640, 680, 700 plus, you then open up the doors to higher leverage and also better interest rates. And the last thing is your mortgage payments being made on time. When we're not going to verify your taxes, or we're not going to verify your income, we need to damn well know that you're paying your monthly payments on time. So the lenders are going to verify that over the last 12 months, you've made all your mortgage payments on time. Sometimes they will allow you to have one 30-day late within the last 12 months, kind of one oopsies, but more than that can absolutely kill the deal. DSCR lenders hate that and will not do the loan. One more thing, you have to still be able to document your income. So if you're somebody who has a rental property right now and you're trying to pull cash out of it, as an example, to go make another move and buy another property, you cannot just go ahead and think that, oh, I'm collecting cash and I know I got this lease, we're good to go. No, we may have to verify what your income you're getting. Preferably, you don't take cash, you get Zelle, Venmo, check. The point with all the DSCR loan is these are the easiest loans to get done, but you just have to be a little bit of a professional. And what I mean by professional is not like you have all this experience. Professional is you're just dialed in with the process. You can verify and document what you're actually doing. With that being said, DSCR loans are not for everybody. If you can't prove that the rent is going to be enough to cover the payment, then the lenders aren't going to do the loan. Also, if you're not going to be very dialed in, not making sure your title's clean, not making sure the insurance is taken care of, not making sure that you're making your payments on time, this is going to be a problem for you. But for my professionals, we turn these loans out so fast because it's a very simple process. S tier all day. If you want to get a DSCR loan on your next investment property, or if you want to even talk about any of the other loan options in this video, feel free to go ahead and click down the link down below, jump on my calendar, have a conversation about your specific scenario. I'll build a custom plan with you to make sure that we can help you grow your portfolio, get the best terms that are available to you on the market, and help you continue to play the game of Monopoly. If you like this video, go ahead and check out this video as well. It's all about how DSCR loans have changed in 2026.